Right about that time, 5:30 on Tuesday nights, Eastern. This is how we roll. Mike, you were in Manhattan today? You made it back to your studio just in time.
Yes, it did.
And the power went out while you were gone, or what's going on?
What do you mean, my office?
Yeah.
No.
It's the darkest I've ever seen it. Oh, nice. Oh, you know what? Today, you know what time sunset was today in New York?
4:69?
4:28. This is the worst time of year.
Not good.
It sucks. All right, let's see who's here. Jay Luther, what's happening? Tyson B, Warren Z, Tim Lalonde. Good to see you, Tim. Sandra Jones, hello. Christopher Caslin. Everybody's here. Everybody's here. I see the bees up for the Duncan Hive. Love to see that. First things first, shout out to Y Charts, best sponsor in the world. Y Charts. I don't even know what else I could say about Y Charts, but I want to tell you guys about an event tomorrow that is free to register for. So far, I'm told 1,000 people have already registered for this. This is going to be me going through the best charts of the year or the most important charts of the year, and then some forward-looking stuff. And we're also going to do a pizza tasting because Sean from Y Charts didn't like what I said about Chicago-style pizza. So I have the Lou Malnati's pies in my fridge, in my freezer. I have the Prince Street pies representing New York. And me and Sean and Caleb and the whole Y Charts team.
What? How'd you get Prince Street pizza to your house? They deliver?
They sent it to me.
Frozen?
Like Goldbelly. Yeah.
Oh.
Yeah. So wait, Duncan, do we have the link for this?
You know, you're an asshole. I love Illuminati's.
I'm a what?
An a-hole.
Why?
For disrespecting Illuminati's. That is a great pie.
I didn't disrespect Illuminati's.
You 100% did. We have the tape.
No.
Duncan, run it back.
No, all I said was Chicago-style pizza is like tomato soup in a garbage can. What did I say? It was bad. But I might get turned around on this. Duncan, what's the link? Do we have it?
We'll have it in the description.
Great job, Duncan. All right, here we go. Topic 1 goes to Michael Batnick in a little bit of a change in protocol. So I think this is the most important thing we could talk about today.
Okay, let's do it.
Show is all yours.
Okay. Was that it? That's it? Stocks bottom after like a 5% correction?
It's a trap.
Is it? Okay, could be.
Too easy.
Nah.
Too easy. I don't know. Too easy. It feels too easy to me. I hope I'm wrong.
Too easy.
That was really
too
easy.
Yeah. What was easy about it? What was easy? You're not the one getting knee clubbed on all of these earnings misses. You don't own Stitch
Yes,
Fix.
I am. Yes, I am.
You don't own DocuSign.
Go look at the drawdowns in CrowdStrike.
That was nothing. CrowdStrike was
PayPal,
nothing.
Matterport. All my names got destroyed. I mean, they came back today, but still, believe me.
All right.
Believe me, I felt the pain.
So let's talk about it. First chart on the put-call ratio, as it always does with these itsy-bitsy drawdowns, spiked. So almost at the highs of the year, just based on this little 5% pullback.
Can you explain to people that aren't familiar with the put-call ratio what this is measuring?
Sure. So you buy puts as downside protection. And people typically do so after the market falls. They rush for protection, right? They buy insurance after the house burns down. A call option, everyone on this call knows what a call option. It's the opposite. You're betting on stocks going up. So when the put to call ratio spikes,
meaning more people buying puts than buying calls, which is a sign of pessimism.
Right.
I'm helping. Okay. So let me put that chart back on, John. So what was this July episode with the put call ratio? Do you remember?
That was when growth stocks got kneecapped the first time? I can't even remember. Was that the Delta? Was that Delta?
Okay. Yeah, that sounds right. It was Delta. So that we had a 3% correction in the S&P that week also. So similar to this one was 5.
So it does feel absurd to think that like you look at a long-term market chart and people are stark like, oh, is at the bottom. But listen, the index, as we've discussed a bazillion times, is not representative of the damage that's been going on underneath the surface. Show the next chart, please. So this is showing in red the Nasdaq new 52-week lows. And new 52-week lows, you don't see that spike in a bull market typically. This is unusual behavior. And we are still very, very, very much in a bull market. And what happens is those spikes at every market bottom. Now, of course, this is not a real-time indicator because the spike will continue until the morale improves, or you know what I'm trying to say. You know what I mean? So, Josh, your thoughts on this?
I think new 52-week lows in general fell off a cliff today, but that's one day. So what is that like? Is that a daily measurement?
Point is, here, put that chart back on. It's daily. Here's what this chart is showing. This chart is showing that despite the fact that the S&P 500 only fell 5%, guess
there was a lot of damage. Yeah.
There was a ton of damage. The number of new 52-week lows in the Nasdaq Composite is at the highest level since 2020, and is about.
Mike, is that the left y-axis? Is that saying 2,000 stocks, or is it the right y?
It's the right. It doesn't matter. I think it's the right.
Okay. So 800 Nasdaq Composite stocks made a new 52-week low. That's a big deal.
Correct.
I think. Okay.
Correct. So anyway, my point is that a lot of stocks have gotten the shit kicked out of it. So it is conceivable that the market did in fact bottom after only a 5% pullback.
Except everybody bought the dip.
They did.
I didn't speak to one person that wasn't like, "Oh, I'm going size," and whatever their favorite shit was. Like people I play tennis with, people on the train, everybody last week and this weekend.
You don't play tennis. You don't take the train. Nice try.
I played tennis. I played tennis last night with J. Rue. You know who I play tennis with.
Oh, he's your market indicator now?
These guys trade.
Next chart.
These guys trade.
Retail investors chart. So to Josh's point, Vander Research does some awesome work. They aggregate retail investor flows. I don't know how they do it. It is super proprietary. But retail investor purchases was, I believe, the highest on record ever. This is a week ago. This is a week ago today. So they were a tiny bit early, but they came in bigly.
Let's take a look. Let's take a look at some stuff from Savita. So Savita's group at Savita Subramanian at Bank of America Equity and Quant Strategy team, they took a look at who was buying this decline last week. The S&P fell another 1.2% last week. They said every single category of clients were buyers. 6.7 billion in inflows, which is the largest weekly inflow since 2017, and as a percentage of U.S. market cap, the largest since last December. They said clients bought stocks and ETFs, and the biggest single stock inflows in a year, and the biggest ETF inflows since mid-September. So they were buying index ETFs. They were buying individual names. All three groups were buyers: hedge funds, institutional, and private client. But I want to highlight what corporates did. Put those charts back up. I didn't get to those yet.
It was little Timmy Apple buying the dip.
So corporates are basically company treasurers or CFOs calling the broker and saying, "Okay, buy right here." So corporate clients did a lot of their stock buybacks last week, and year-to-date buybacks are still tracking 7% below 2019 levels, but this was their highest weekly buyback since March. And if you look at the industry breakdown in the top left corner, you can see technology companies really took full advantage of this. If you look at the the bottom right corner, you can see that buybacks are a leading read. So I think I thought that was really interesting.
Well, here's one more. What? Finish.
Yeah. Let me say. No, that's all I got.
It's enough out of you.
It's a lot.
Balchunas tweeted, ETFs yesterday took in $12 billion, triple the already absurd $4 billion average. And the top three were SPY, which is State Street's S&P 500, VOO, which is Vanguard's S&P 500, excuse me, and TQQQ, which is the levered Nasdaq 100, which was probably up. How much was it up today? I don't know, 6, 7, 8%. A lot.
Yeah.
But here's what I can't wrap my head around. Why are people so bullish?
Because that's the behavior that's been rewarded pretty consistently for years now. Why wouldn't they be? Why would every time? All right, let me put it this way: every time the rat pushes its nose against the button, a piece of cheese comes out of the hole. Why wouldn't they keep pushing their nose against the button? Why does it have to be more than that? It's reflex. And by the way, these dips are real. We're not talking about a stock falling 10 points. We're talking about stocks cut in half. Some
worse.
very worse in some cases. It's not like people just rushed out and bought like the first sign of a dip. These stocks have gotten killed in many cases.
So I don't know if these stocks got bought, but maybe that's the point. Is that
Apple didn't get killed?
Yeah, maybe that's the point. Is that the people that are responsible for all of these flows are financial advisors, right? SPYVOO. And why do they give a shit that DocuSign got killed? That's not slowing them down.
No, of course not. Because that's a company specific thing. DocuSign didn't get killed because of the macro. DocuSign is not executing, and is facing very specific competition from Microsoft Teams, Adobe. That has no bearing on whether or not the treasurer at a semiconductor company wants to pull the trigger with his stock price down 15%.
Stitch Fix is down 90% after hours. You know of course you know the No Mercy gift from Karate Kid.
Yes.
That's what the market is doing to these stocks after they miss earnings. So Stitch Fix was
probably already got killed.
It did. So going into this earnings, Stitch Fix was at 25, down from 113 in February. So going into earnings, it was down 70% more. Guess what it's down in the after hours? I'll tell you, 20%.
Stitch Fix at 130 in February, you said? That's pricing in nobody ever going and buying a piece of clothing in person,
dude,
ever again.
That
is so insane.
It fell 80% before earnings, and it's down 20% after earnings. Does that mean it's down 100%? Is my math right?
No. Does it look as bad as Zoom or Peloton? I don't know if anything could.
It looks worse. I mean,
maybe worse.
80.
80's bad.
80.
Yeah. Wow. Well, the good news is keep making new stocks. So if you got tired of that one, there's new ones.
So the market cap got as high as 11 billion, and now it's below 3. It's rough.
Did you ever?
It's gonna be below. It's gonna be.
Did you ever try? Did you ever try Stitch Fix?
I don't shop.
Did Ben ever try Stitch? I feel like that could be a Ben thing.
He's 100% a customer.
He loves it.
He loves it.
Okay.
Big fashion guy.
Yeah. All right. Let's keep moving. I want to talk about the retail options boom.
Wait, hold on. Before we move on, did the stock market bottom?
I think too easy. I think we're going to revisit.
Okay.
I think even if it's a retest, I think we're going to revisit. By the way, there was a defensive character about today's rebound away from technology. So
what do you mean? What do you mean defensive?
The only reason I know that is because I read my email subject lines. There was a defensive tone to the bounce. I'm just telling you what I am being informed.
Okay.
This is a Wall Street Journal article. Investors are using Robinhood and other platforms to jump into options trades, worrying U.S. regulators. You know what this made me think about, this piece? Mm-hmm. It made me think about, like, if you're a libertarian or if you're like a nanny state liberal, one side or the other of that spectrum is like where you would fall in this debate. So let me set this up.
You lost me. Go ahead.
Around 39 million options contracts have changed. I'm saying this is ideological, okay? This is not even about regulation. 39 million options contracts have changed hands on an average day this year. That's up from 35% last year. And we thought last year was an options bubble. This is the highest level ever of daily options contracts. 39 million contracts on an average day. Think about how big. Go.
Can I? Is it too early to take a victory lap that people don't get unaddicted to trading or to gambling?
Too soon.
Well, oh yeah. All of their favorite trades got killed, annihilated, and it didn't slow them down one iota. Not too soon. Planting my flag, declaring victory.
Okay, let's finish. So what this article is saying is that the regulators now feel like they have to step in and do something because people are being like influenced to do all these options trades by the user interface of the apps,
right?
Or there's some sort of like a mental reward they're getting for pulling the trigger and pressing buy. And we know that there is a lot of that, but like at a certain point, don't the regulators just have to say, you know what? Fuck it. Let them play. Like, why are we still pretending there's this difference between approving sports betting and approving the lottery, but like regulating options contracts as though it's different people engaging? It's all gambling.
Oh, yeah, fuck it. That's your answer to everything, Mr. Lebowski.
Not everything.
It's not. Here's why. Because if you want to, nobody thinks that they're going to get rich quick and ruin their finances opening a DraftKings app. Not nobody. Most people. This is much more potentially harmful to millions of more consumers. It's not.
Why
the same
is that?
thing.
Because the dollar amounts are bigger, or because these people think they're investing?
Because it's so easy to be influenced by an idiot on Instagram or TikTok, whereas most people that are gambling on Robinhood are not going to succumb to the same idiot giving draft picks.
This is free will.
Well, I agree with that. I'm saying
Nobody is telling somebody. Nobody is managing someone's money and doing 50 options trades a day. These people are doing this themselves. At what point do we just have to say, yeah, some people are going to blow themselves up in the stock market, just like they were in the 1700s?
I'm with it. I'm with it. Oh, yeah? Well, how come we can't have a Bitcoin ETF?
That's what I'm saying. All right, listen.
By the way, I've been on this side. If you could have
So
TVIX,
I'm coming over to your side.
If you could have TVIX and all this other bullshit products, what's wrong with what are they trying to? They're trying to regulate options. Let them have it.
All right, here's a great quote. I thought this is funny. Quote, if FINRA tries to tighten the suitability rules, I think that would be a massive mistake, said Scott Sheridan, chief executive of Tastyworks, an options brokerage. Wait. People should have access to any trading tool in the toolbox as long as they have the money to meet the capital requirements.
That's a hilarious quote. That's hilarious.
Wait, here's another quote.
Oh, my God.
Camel Joe said, everyone should have access to cigarettes.
Right.
Like, what are we talking about here? Right. Who would even put that quote in an article? The leading options brokerage thinks that people should trade options. Yeah, no shit. We know you do.
Right.
Listen, if you would have asked me 5 years ago, should regulators step in and shut this down and educate? I've changed my mind on this. I don't think these people want to be prevented from hurting themselves. I don't think that they've learned anything in the short time that we've been in this post-COVID bull market. I think there's got to be some pain and some real lessons learned. I don't think more disclosures is going to do.
Oh, let's talk about this nonsense for a second. Now that all of the Wall Street bet traders and all the Robinhood traders have learned their lesson, they have experienced a brutal bull market. What are you talking about? All of their stocks are down 70%. What more does it take?
What if they were using these options trades as hedging and they're not down 70%?
That's galaxy brain. But anyway, my point is, can we stop with the nonsense? Can we stop like wagging our finger and say, well, guess what? They just had their own bear market. Can we get on the other side of that valley?
Yeah, let's regulate it now.
Yeah, now we regulate it. Anyway, let's move on. You have anything else on this topic?
Tell me if you agree. So this guy, Tyler Galash from Healthy Markets, which is a group that advocates for stricter financial regulation. I don't know for whose benefit. These people want to gamble, but okay. Quote, retail traders can be lured into options. Lured.
True.
Is a carrot on the end of a fishing pole. Retail traders can be lured into options trading because of the leverage, okay? But the winners are almost always the lightning-fast computers that are trading against them. True or false?
100% true.
100% true. They don't care.
But so what?
They know it and they don't care.
And guess what? You do it enough times and that stuff you get bored of. I thought. Maybe I'm wrong.
Or you run out of money.
Right.
Yeah. So, listen, I am starting to come to your side of this, which is like, just let them do what they want.
Also, come on, look at the other side of this and all of the billions of dollars pouring in every week into mutual funds and ETFs of these same people are also being responsible in their 401ks. So it's not like everybody's a crazy lunatic and blowing themselves up. That's just not reality.
Yeah, of course. It's a subset of investors. It's not every investor. And we know that based on ETF flows.
Right.
So we know that that's not what everyone is doing. So I feel like if people are opting to behave this way, like at what point is regulation
like
missing
So if we're going to regulate options, regulate Diet Coke.
Do you say that because I'm drinking a Diet Pepsi? Wait, what's wrong with Diet Coke?
It's the same shit. It's bad for you. All right, fine.
This is not good?
Yeah, hilarious. All right, let's move on.
All right, let's keep going. So what do you got?
Let's talk about BuzzFeed. This whole situation is a freaking disaster.
Can you explain it to me because I don't understand
Honestly,
it.
no. All right, so there's a lot of things happening. From what I gather, NBC, which I guess Comcast. Is that
Yeah,
Comcast?
be careful.
Yeah, no, I'll say what I gotta say. I don't care about your employers, sir.
Okay, Duncan, we can edit this.
So NBC invested $200 million in BuzzFeed in 2015. They invested another $200 million recently at a valuation of $1.7 billion. Now, Comcast, whoever, is underwater, wants favorable terms on a SPAC deal. At the same time, BuzzFeed is negotiating with their employers and not doing the right thing by their employers, not paying them a living wage.
Employees.
Employees. And so on the day of the SPAC or the IPO, which I think was yesterday, employees staged the walkout. So that's like two shitstorms. And then there's a third piece of this, which is hilarious. So once this deal was announced, 94% of the money of the pipe money, the hedge fund, institutional money in this deal said, no, we're out. I want my money back. So there was $287 million in this SPAC. 94% of the investors redeemed. And then there's one more thing that I want to talk about. Actually, two more things.
Wait, and the deal happened anyway?
The deal happened anyway.
How?
I don't know the details. Two more things. I don't understand this. Last month, BuzzFeed said that they generated revenue of $90 million, 20% increase year over year, thanks to a 39% increase in advertising sales. Okay, so $90 million in revenue for a company that does, advertising, clicky stuff, whatever. And the company said it lost $3.6 million for the quarter. How? How is every single company losing money, seemingly?
Well, this company, BuzzFeed in particular, has been spending a lot of money on acquisitions. Like they've bought a lot of properties. They're like aggregating.
And
I have to be honest. I don't understand this at all. I don't understand why anybody would want to invest in this.
So this is hilarious. So yesterday at the IPO, there was headlines, a lot of buzz because the stock jumped 50%. And then it closed down 11%. Throw up this disgusting eyesore of a chart.
Get the fuck out of here!
Look at this nonsense. So this is
Wait.
What?
Wait, it went up how much when
50.
it opened for trading?
50. Look at that candle yesterday. Now look at it today.
Holy shit!
Disgusting, ludicrous, disgusting.
Disgusting.
Chart off. Get this off my screen.
The playbook is like
happening?
Huffington. This is like investing in Huffington Post. Like I don't understand the investment case for this. It's banner ads, which might be the worst business on the planet. It's aggregated content, which is mostly like low quality. Just write something for clicks, move on to write the next. Who's even reading this stuff anymore? Is anyone doing the quizzes? Is anybody saying which Disney princess they are?
Not to be disrespectful, but I feel like BuzzFeed is completely irrelevant at this point. I mean, they had like a giant day, like they were big. They were really big.
They've had some amazing journalists over the years.
Yeah,
like
they were huge.
Like Ben Smith was there, and they've done like really important political work.
They were very important to the cultural zeitgeist in 2016. I don't know.
11, 14. Listen. I personally don't want to invest in any media, so I definitely don't want to invest in this. All right. I feel bad for the employees. The employees are trying to unionize, or they're trying to get management to agree to a $50,000 salary floor, which sounds very reasonable.
Especially because there are probably a lot of employees that are based in New York,
and it's kids. So they're hiring kids right out of school, journalists coming right out of school. For a lot of the employees there, it's their first gig. You got to pay these people $50,000. How are they supposed to live in Manhattan or Brooklyn? You literally can't do it.
So the point is, they're sweetening the terms to NBC, Comcast, whatever, and not paying the employees. That looks shitty. Not as bad as did you see Better.com, the CEO who laid off the employees on Zoom?
Yeah, I think there's more to that story than what Twitter originally picked up on.
Yeah, like what?
But we're gonna talk about that on the Compound and Friends this week. Okay. So let's not step on it.
Okay.
I probably have an opinion that's different than yours. Okay, Nasdaq unseats the New York Stock Exchange. I was blown away by this, but apparently it's been going on for a couple of years now.
I honestly didn't even know this was news. This was news that it was news. I know the New York Stock Exchange is an established.
Throw this first chart up, John. I'll show you the news.
Go ahead.
Look at the degree to which Nasdaq is now outpacing.
All right, that's wow.
Outpacing the New York Stock Exchange for listings. And
I have
granted,
a hypothesis.
There's a lot of shitty SPACs in here, but the New York Stock Exchange is doing those too.
Josh, that was my hypothesis. You know where BuzzFeed listed?
Nasdaq.
You think New York Stock Exchange would ever let that garbage on their exchange?
Maybe because they've done a bunch of SPACs.
Probably.
Probably. How much money's involved?
Listen, you cannot put a price on integrity.
Yeah,
But how much?
Welcome to Wall Street. All right, Nasdaq is poised to beat the NYSE in IPOs this year, far outpacing its crosstown rival during a record year. IPOs at Nasdaq have raised $191 billion this year through Friday, versus $109 billion for the New York Stock Exchange. This would be the third year in a row that Nasdaq beats the NYSE. One factor that's helped the Nasdaq was its effort to brand itself as the exchange focused on ESG. No, nothing.
Honestly, stop listening.
Yeah, I have nothing to say there. All right. I thought that was interesting. In 21, the biggest deal was on the Nasdaq. Do you know what the biggest deal of the year was?
21? Yeah,
Yep.
Airbnb.
Rivian Automotive.
In 2021? Oh, I forgot what
This
year it
year.
was. I swear I thought it was 2020. Rivian, okay.
$13.7 billion. That was the biggest. The Nasdaq also got Robinhood. It got Bumble.
It's a pretty chart.
And it got the return of Krispy Kreme.
Wait, hang on. I'm looking. So we got Nasdaq up top, NYSE downstairs. You know, this is a beautiful chart. Who did this? Is this the journal?
This is the journal with data via Dealogic. I think we lost your mic though.
Oh, sorry. I was like this.
Oh. All right. Nasdaq won 63% of all the money raised in SPACs, up from 39% last year, and SPACs accounted for half of the $300 billion total raised in all IPOs this year. So SPACs, whatever shit you want to say about them, and I want to say a lot.
Oof.
Still a lot of SPACs this year.
Pull up the Nasdaq chart. Killing.
What?
On
Killing
fire.
what?
Oh
Yeah.
my God, that is
An exchange.
I was
All right.
I was thinking like this is a lucrative enterprise.
I want to give
companies.
I want to give a shout out to Adina Friedman, who I think deserves a lot of credit. She's the CEO at Nasdaq. Whatever she's doing, whether it's doing the ESG game or whatever, it's working. And
Stock's up 55% year to date.
yeah, it's rocking. All right, last thing on this: two big IPOs this week of interest. I thought you would be into this. There's a blank check Dow company coming out.
No, the ticker is Dow. It's not a blank check Dow.
That's what it is.
No, it's not.
Yes, it is.
It's not a Dow.
Yes, it is. Do you do any research for the show, or
It's
am I
not a
just
Dow.
think-
Fine.
We are okay. Crypto One acquisition, blank check company targeting digital assets and crypto exchanges. We are a blank check company. We may pursue
keep reading,
DeFi.
jackass.
No, they're dude.
It's not a Dow.
They're going to invest in a DAO.
They're investing in crypto assets.
They're going to invest in something that supports a DAO.
Yeah, nice try.
The ticker is DAO. All right. New holdings.
The ticker. It's actually a great ticker. I didn't know that you could do this. It's Dow OU. We got 5
DAO OU.
or 5 tickers a thing in crypto.
Well, I think once they merge, they'll change the ticker anyway.
Oh, is
so that'll
Dow
just be the
taken?
stock ticker. Do you know about New Holdings? NU? Do you know about this thing?
No. Oh, yes. Is it like SoFi for Latin America?
Sort of, yeah. It's a neobank, 48 million customers, but it's gigantic. $40 billion valuation. They're going to raise, this is tomorrow, they're going to raise $3 billion. And Warren Buffett invested $500 million in this. So this is way bigger than SoFi, just in terms of like how many customers and how much revenue, et cetera. But it's mostly like Brazil. And I don't know what Buffett gets hyped up about certain fintechs that are not like doesn't Berkshire own Stone Co or whatever that is? It's another Latin American fintech. Didn't they invest in that too?
Do we don't know that's him or Ted or Todd. Like we don't know. Who's
Well, whatever. It's
Yeah.
Berkshire Hathaway invested it at a $30 billion valuation, so they obviously see something there.
All right, this is interesting. So Bloomberg did an article about recurring revenue loans. Like obviously the equity market has placed a massive premium on recurring revenue. We seem to like that, right? It's a good business. Makes
What
sense.
is that? What is that exactly? That's like
Subscription.
a company that's got subscription revenues, securitizing them.
Yeah.
And okay, got it.
So I forget who wrote this article, but after years of watching the equity market pour money into unprofitable but high growth technology companies, the credit market appears to be doing the same. So I don't know exactly how this is going to work, but they said that where once the bulk of recurring revenue loans were extended to companies with more than $100 million in annualized recurring revenue, 2/3 of loans are now going to businesses with less than $100 million. And this brings me to another point that I wanted to talk about, but we don't have enough topics. Are interest rates ever going up? People are so starved for income anywhere that now we're doing stuff like this.
We had Marko Kolanovic on the show today, and he wrote his whole 2022 strategy piece, and he's pretty certain the 10-year will see 2% in 22. I don't know what that means for Fed funds rates because the 10-year will follow, I think, what Fed funds rates do, but I don't think that we're going to be in this 0% environment for much longer. And projects like this might have. Well, listen. We know that the terminal rate is not going substantially higher.
So I don't mean that the Fed funds that they won't lift rates. The Fed will probably move, but I don't think, and obviously the market could prove me wrong very quickly. I don't think the 10-year is getting above 2.25.
Okay,
for a long time.
Let's say next year Fed funds rate goes to 75 basis points, and the 10-year is
aggressive.
at 2. 10-year is at
That's
2.
Aggressive. That's not happening.
You don't think we'll have 3 rate hikes next year?
Nope.
That's consensus.
Okay.
Consensus is the taper.
Found the
consensus is the taper's over by April. The taper's over by April, and rate hikes start in June. That you think that's
3 rate hikes between June and the end of the year, dude? No.
Really? Impossible. Impossible. At full employment.
What do you mean impossible? I'm not saying nothing's impossible.
All right.
I don't think so.
All right. I'm not saying I'm sure that will happen.
Wait,
I'm just saying it's not outrageous.
Are you consensus?
I've always been consensus my whole life. All right, let's do this fattest pitch for 2022.
I don't even know what you're talking about here. What's going on?
I think this is one of the, I don't want to say easiest trades. There's almost nothing that didn't work this year, right? If you think about it. But
not
biotech,
true. What did we just talk about, dude? All those high growth stocks got murdered.
Yeah, but if you look at the tech year to date had a great year.
Okay, tech worked.
You're talking about stocks that aren't even in the S&P.
So what? Those are the names that are in everybody's portfolio.
Okay, I'm just saying.
Zoom
is not in the S&P 500.
The most heavily owned name, literally, Jim Bianco had an amazing chart this week showing the most crowded stocks are the ones that got killed. So I don't care that Zoom's not in the S&P 500.
Well, my point is, if you're looking at sectors in the S&P, you're looking at the indices. Those stocks, A, aren't in it, and B, some of the ones we talk about a lot, even if they were in it, they wouldn't move the needle.
Here's what we would agree on. Every S&P 500 index worked very well this year. Continue.
Okay, but at an industry group level, biotechs, I thought, were a very, very notable standout to the downside.
You're right.
They look like shit.
What's the fat pitch?
A lot of the damage has been done the last few years. A lot of the rationale behind why these haven't worked is because, quote unquote, they're reopen and they're not cyclical and they just don't have a place in the narrative. I love shit like that. It's so dumb. So there are some very, very exciting companies in these indices, and there are some very stable companies in these indices. Talk about recurring revenue. There are just I think some great opportunities here. So let me just give people a sense of the magnitude of underperformance, because it's pretty notable to have a bull market year like this and biotechs suck.
True.
The XBI, which is the equal weight, it's 40 biotechs. All of them represent about 2% in the ETF. That's down 22% year to date through Friday.
And almost 40% drawdown.
40%, 37% from its February peak.
Gross.
That's a big deal.
Gross,
That's glaring.
Yeah.
The ETF has tumbled nearly 9% since Thanksgiving. Biotech is the worst. All right, this is what's his name? Greg Zuckerman. I got to correct him. Biotech is the worst performing of all 11 S&P 500 sectors this year. It's not one of them, but
right,
okay.
That's the Wall Street Journal's fault. That's his editor's fault.
He shouldn't have to know that. Put this chart up of all the ETFs.
That ARK one.
So here's the problem with ARK. That has its biggest holding is Teladoc.
Okay.
I don't know how the fuck that's
genomics.
I really don't know, but I bet you people are like, no, I'm not buying that. let's see, the blue line down 22% is just the S&P Biotech ETF. These other two are interesting. They have immunology, genomics, like vaccine discovery. They have like all the right things that you might think would be interesting to own. So the one I'm thinking about is the purple. I think the purple line is iDNA, which is not biotech, straight up biotech. It's a little bit more nuanced. It's about genomics and DNA therapies. So I might pull the trigger on that as my fat pitch trade for 22. I think there's some opportunity there.
Yeah. What do you think about Duncan? Is Beyond Meat your fat pitch of 2022? You see this stock, Josh?
No.
Went from 221 to 63. Holy moly!
It's painful.
What's going on with like revenue and earnings and stuff?
It's not good. I was just talking to Duncan before you hopped on. So this should be a growth stock. It's not growing.
Is that because the Beyond Meat burgers taste like an alien's dick? Why would
watch your mouth?
Okay.
We got a
sorry.
vegan on the phone.
He doesn't. Do you like the burgers?
Duncan, step in.
I think they're fine. Yeah, it's not. I like the Impossible too. I like the Beyond Chicken Tenders. Those are good too.
The tendies, Duncan.
Stuff. Impossible now has those too, though. So.
Real quick, if you were to say, Josh, before you talk shit, you have to try something. What would you have? Knowing I feel like you know my taste, and by taste I mean I literally will eat anything. But I feel like you know my taste to some extent. What is the one item from either Impossible or Beyond I have to try before I talk shit?
I would say try like a really good pasta made with Impossible ground beef. It's very good.
I would suggest
like
the Impossible Whopper. I like it.
That's good too. Yeah.
I really like it.
Just go through the Burger King drive-thru and get the Impossible Whopper.
Yeah.
with
The
cheese.
Impossible, to me, the Impossible is much more like real beef. Beyond is like a totally different flavor. I like it, but it doesn't taste like beef.
Okay, am I going to feel like, oh, this tastes just like a burger, or I'll know it's not a burger, but it'll taste good either way?
You'll know it's not a burger because you're gigantic.
And I'm ordering it.
No, I mean,
Right.
I'd be curious.
I'm the one getting
You
it.
should do it, and then we'll talk about it. I'm curious to hear your
It's
take on
good.
it.
It's good.
All right,
I'm curious.
I feel like I'll give that a shot, and then we'll revisit this conversation. All right, Duncan, let's get to viewer topic number 1.
Okay. So first up, we have a question from Alex, who writes, something that I've been considering is the risk of a U.S. debt default.
Same.
This is a unique question, so that's why I chose it.
Why are you laughing?
How would a debt default affect property values? Should I be looking at how Japan's property market reacted from 88 to 92?
I don't think the problem in Japan was a debt default, though, so I'm not sure. The question seems like a non sequitur. Mike, what am I missing here?
All right. Here's the thing. Well, if you knew the U.S. default, it would probably not be good. Remember when S&P downgraded our debt?
Yes,
2011?
Yeah.
How
during
bullish
the
was
debt
that?
ceiling debate.
How bullish was that?
The bond prices went up. That's all I know. So
I really feel like, sorry I left, with all sincerity here, this is like a big waste of time. Worrying, like trying to handicap whether or not we're going to default, which we're not. But let's just say that you could handicap it. But then what? It's not like there's a market where you can bet directly on. You're not like buying credit default swaps on the U.S. debt.
we would have a depression, and then we would probably turn the debt into equity, and then sell that. Like that happened in England. Like this is a thing that's happened before. It would suck.
Nobody wants a history
obviously.
lesson. We can't even get the S&P 500 falling 5%.
No, it's not a history lesson. I'm saying for
here
hundreds of
we
years. For hundreds of years, though, governments have defaulted on debt. It's never pretty, but it doesn't like put an end to the country. In fact, the whole reason for the South Seas Company in England was they sold shares in a venture that had the right to trade in the New World. Guess what they sold those shares for? To monetize the debt.
Ethereum.
No, I'm saying that's how they dealt with the debt. They just invented an equity and sold it to people. And then they said, we're going to give this joint stock corporation, by the way, this is the invention of the stock market, we're going to give this company the ability to have the exclusive right to trade with the New World.
Duncan,
Like they
don't
fixed
worry.
the debt
It's not-
problem.
It's not a history lesson. What does this have to do with property
We
values?
will do that with March.
What?
with Mars.
What?
Yep, that's what I was curious about. Why they're asking how it would impact property. And
Hey,
real
let's go
estate.
next.
Yeah.
Thanks
All
for the
right.
question. We're baffled as to how to answer it. Let's go next.
It was different than the leveraged ETF questions, which we get like 5 of a day now. Which
Sure.
Okay,
What,
so
they
next
were
up,
asking people. They were asking us to bless that. Is that every
kind
question?
of asking for strategies on
like-
leveraged ETFs. Everyone's into that now. It's a big
Right.
thing.
And this is the regulators want to save these people. By the way. All right. Go ahead, Duncan. What's
Okay,
next?
so next up, Matthew writes, I'm a new financial advisor, 25 years old, at an independent financial planning firm in California. I'm on a contract where I have to produce X amount of insurance in 3 years, and I'm finding it difficult to build a client base and get AUM early on, which I expected. I have built great relationships with COIs, which I've learned is centers of influence, and receive referrals somewhat consistently. However, the lack of pay from insurance and non-existent AUM is making me second guess where I am career-wise and financially. Is it worth looking at going to a discount brokerage and getting a salary and incentives, or buying another book of business, or should I just stick it out for a few more years?
This is really hard. There are a few things harder in life than starting from zero and building up an insurance practice. If you're trying to go outside of your existing group of friends and family. So when you start like trying to network with COIs, which is like center of influence, like an accountant who has a lot of clients, or an attorney, or maybe a hairdresser, when you start doing that, like, it's so hard. They have a million insurance people trying to get their attention for referrals. So I don't know that I would tell you to give up, but I would say you really have to come up with like a way to build your own influence and not rely on COIs.
Nope.
What do you think, Michael?
Nope. Here's my response.
What is this?
It's the Get Out meme. It's a Get Out gif.
That was very clever. How long did it take you to pull that out while I was talking? I know.
13 seconds. Listen,
Okay.
Get Out right now.
What do you want this kid to do?
Do what I did.
What?
Don't
Literally?
do what I did. Don't do what I did.
Come on. Are you
But no,
crazy?
Stop. I did this, dude. Don't tell me. I did this. Worst. I don't say worst. Very difficult job to call people that don't know you, that don't want to buy products from you. It's impossible. And to have that pressure, the weight of the world that you have to sell insurance to people, it's awful.
Justin Castelli in the chat. At Duncan, tell that young advisor to hit me up. I'd be happy to talk with him and give him some advice. All right, what's his kid's name?
Matthew.
Matthew, if you do nothing else with the rest of your day, take Justin Castelli up on that offer. That's as good as it gets right there. Justin has been mentoring advisors for years, has tons of connections, has tons of perspective. Wow, so you're a little bit more extreme than I am. I think what I'm saying is like start a blog. I think what you're saying is do a career change immediately.
No, this is dead end. Dead end.
Okay.
Less than 1 out of 1,000 advisors. Guess what? They don't even do that anymore. They don't even have those training programs anymore.
You know you barely get paid on life insurance too, so you got to sell some weird shit
What
to
do you
get paid.
Yes, you do. 50% commission.
No, the premiums are not. You can't make a living on that. The amount of time it takes to do that.
Oh, you get a
somebody
50% commission. You can't sell
On
any
a-
policies. You can't sell any policies.
on a term life policy.
50.
Right, but if you sell 5 of those a year, you can't earn a living that way. How many people do you know that just had a baby?
I agree.
Yeah, very difficult. All right, I don't want to start end this on a down note. So let's just do this. Throw the Y charts thing back up for the thing tomorrow. Yo, come join us. It's gonna be a lot of fun. We're gonna do some charts. Michael's got a chart in there. Ben has a chart in there. Charlie Bolello, Blair. Tyrone's got a chart in there, so make sure you join us tomorrow. That is at 1 p.m. Central, 2 p.m. Eastern, and here is the URL, tinyurl.com/2021charts. Okay, thanks so much for watching. Make sure you guys are subscribed if you haven't already.
Get a job at Fidelity or Vanguard, young advisor.
Get a job at Fidelity or Vanguard if you haven't yet. Smash that like button. Subscribe to Fidelity or Vanguard. And we will see you guys very soon. See you next Tuesday night.